Good afternoon and welcome to the fourth session of our Money Lecture series by the Institute of International Monetary Research in collaboration with the Vinson Centre at the University of Buckingham. This is a series on the evolution of central banks and their roles in financial crisis by two experts in the field, Professors Charles Guhart and Forrest Capie, both members of the Institute's Academic Advisory Council. I'm Dr. Castañeda, Director of the Institute, and today we'll be hosting Professor Forrest Capie. Forrest Capie is Professor Emeritus of Economic History at the Caspian School, City University in London. After a doctorate at the London School of Economics and a teaching fellowship there, he taught at the University of Warwick and the University of Leeds. He was a British Academy Fellow at the National Bureau in New York and a visiting professor at the University of Marseille and the LSE, and a visiting scholar at the IMF. He was a head of the Department of Banking and Finance at City University from 1989 to 1992, editor of the Economic History Review 1993-1999, a member of the Academic Advisory Council of the IEA in London, and an advisor to the Shadow Chancellor of the Exchequer. He has written widely on money, banking, trade, and commercial policy, and recently completed the commissioned history of the Bank of England, published by Cambridge University Press in 2010. His latest book, Money Over Two Centuries, was published by Oxford University Press in 2012. He has been advisor to UK's Parliamentary Commission on Banking following the global financial crisis. Professor Capie will discuss today the roles of central banks in great financial crisis, after which we allow time for Q&A with viewers at home. Today we'll be covering the 20th and the 21st century crisis episodes. Today's presentation will be recorded and made available on our YouTube channel. Questions must be submitted via the chat option on Teams, and I will moderate them and address them to the speaker. Forrest, we are very grateful again for your contribution to this series, the second of your lectures in this series, and we are honored to host your lecture. So the floor is entirely yours, please.
Thank you, Juan. Well, last week, after a brief introduction on the elements present in a financial crisis and a discussion of what a central bank could do to avoid or contain or resolve such crises, I considered some of the crises of the 19th century and how the Bank of England evolved into its role. This week, I turn to the two great crises of the 20th and the 21st century. First of all, that of the Great Depression in the period 1929 to 32/3, where in spite of the lessons and the experience of the 19th century, the central bank, in this case the Federal Reserve, got it badly wrong. And then secondly, to the global financial crisis of 2007/8 or 9, where the major central banks largely got things right, but with some caveats. Both of these crises had a considerable focus in the US. And then I will conclude by asking where have we got to in terms of central banks and major financial crises. So we can move to the next slide, please. The United States between 1929 and 33. These years in the United States, 29 to 33, witnessed several financial crises that were followed or accompanied by the greatest collapse of an economy that there had been up until that point, the worst economic depression in America's history. Now, this topic has been the most intensively researched in monetary and indeed economic history. So what follows is really just the barest of the outline, but I hope with the appropriate focus. The American economy enjoyed a strong boom across the 1920s with a minor dip in 1926. This was the Jazz Age, the great migration from the South urbanization, the age of the automobile, radio, aviation, etc. The stock market soared, and there was undoubtedly something of a bubble in at least some of the stocks by the end of the decade. But it seemed that nothing could go wrong. And in 1929, before the economy peaked, 1,000 economists signed a document to declare that the business cycle had been eradicated. Such was the optimism. The boom was fed in part by low interest rates in the mid-1920s. There was a huge property boom, with commercial bank lending increasingly responsible. There were second mortgages with relaxed conditions and securitization and so on. In fact, commercial banks' real estate loans would turn out to be the best predictor of commercial bank failure. In short, they were all the features of an emerging crisis that had been common and that we discussed last week. Then in 1928, the Fed began to take fright. It decided there was a problem in the stock market that it should do something about, and it tightened monetary conditions. This had the effect of attracting funds from abroad back to the US and further fueled the stock market boom. But the economy peaked in the middle of 29. At that time, some banks were failing. Though it has to be said, there were so many banks in the US that there were frequent failures, but the numbers here were up. In fact, there were something like 36,000 banks in the US at that time. Over the next few years, in the crises of 29 to 33, something like 12,000 of these banks would fail. Now, in October 29, the stock market crashed. But it was not the stock market that caused the depression, and nor was it the Smoot-Hawley tariff that was introduced in 1930. Neither of these, of course, helped, and both probably contributed by different means to the deteriorating climate. Now, the Fed, apart from having brought about the downturn by its intervention in 1928, it then failed to do what it was supposed to do. What it could have done was to prevent the downturn in the economy, which derived from the contraction of the money supply, from turning into a recession, from a recession into the Great Depression. There were several points along the way at which it could have and should have acted. There was an ebb and flow of confidence, but at the crucial points, it failed to act. The most distinguished contributors to this subject were Friedman and Schwartz. They argued that the first banking crisis that came towards the end of 1930 and the collapse of banks that resulted produced the decline in the stock of money that turned the recession into the severe depression. There were further banking crises in 1931 and again in late 1932 stroke into 1933. These brought about by the failure of the Fed to respond to the earlier crises in a way that it could have and should have done. There's some disagreement about why the initial bank collapse took place, but what matters for our purpose is that the Fed failed to take the action that it could have done to avert the collapse. It failed to do what central banks should do in these circumstances, and it turned out to be a colossal failure. The Federal Reserve had the know-how and the necessary techniques and resources. It could have engaged in open market operations of a kind that it had already used in its quite short life. It even had sufficient gold reserves not to need to suspend the gold standard that had been the British response in the 19th century. but it misread the signals. It judged the tightness of money by its own interest rate rather than by a measure of broad money. At some points, it did in fact provide increasing quantities of high-powered money, but it was hopelessly inadequate. It failed badly in providing the required liquidity. Now, the scale of that disaster can be read from the macro variables. Real output fell by 33%. Prices fell by 25%. Unemployment rose to 25%. That was 13 million people. Over a third of all banks failed. The stock market, measured by Standard & Poor's Composite Index, collapsed from a peak in September 1929 of 254 down to 162 at the end of the following month, and it carried on falling to a low of 50 in 1933. This was indeed a Great Depression. Recovery then began in 1933, and there was strong economic growth, albeit from a low base, at 9% per annum from 33 to 37. That's the upswing of the cycle. And then even stronger at 10% for 38 to 41 after a short recession in 37, 38. Now, it was not fiscal policy that did the trick. Most modern research regards the New Deal as at best neutral, though much of it regards it as negative in its impact. And neither was it the recently introduced tariff, more cause than cure. The principal explanation for recovery was the stimulus given by monetary expansion. That was not brought about consciously by the Federal Reserve, but rather by accident. The monetary base, and broad money with it, grew by 10% per annum between 1933 and 37. The beginning of the recovery coincided with the US leaving the gold standard. The aim of that policy had been to raise the domestic price level through depreciation of the dollar that would raise commodity prices first. The expectation of inflation turned formerly high positive real interest rates into negative rates. This was accompanied by the restoration of confidence in the banking system that Roosevelt was in part able to inspire with his famous fireside chat, and then the long bank holiday of March 1933. At that time, the insolvent banks were closed. Then deposit insurance followed in January 34. But the message of the Great Depression was the strong boom of the 20s, credit fueled boom, which was brought to an end by the Fed intervening, and then worsened at every turn by the Fed not responding to the collapsing banks at in different parts of the country. Now, it's worth, before leaving these years, to turn to look briefly at the British experience. For how much of the rest of the industrialized world and the developing economies reliant on them also experienced banking collapses and went into deep depression, there was no comparable experience in the United Kingdom. It's true there were stock market shenanigans with the fraudster Clarence Hatry, but while the market fell from a peak of 129 in January 29 to a trough of 109 in December 32, that wasn't reflected in the economy. The banking system was sound. Some smaller banks did have difficulties, But the payment system was sound, not threatened in any way. The profits of all the main commercial banks were relatively unchanged through the period, even if there was little tampering with their presentation. There was no Great Depression in Britain between the wars. Neither was the 1920s a depressed decade. There was a recession between 29 and 32, with a fall in output of 5.6%. There was a rise in unemployment, quite a steep rise in unemployment, but that is better explained by real wage movements. The financial system remained robust throughout the whole period, and British growth in the 1930s was faster than it had ever been. The economy experienced the strongest upswing it ever had to that date, a growth of 4% per annum from 1932 to 1937. There were serious financial problems in most of the rest of the world, and Great Depression too, but financial stability remained in Britain. What happened in 1931 was an exchange rate crisis. The return to the gold standard in 1925 had taken place at an overvalued rate, one that could not be held to, and was abandoned in mid-1931. Leaving the gold standard, of course, allowed the freedom to have an expansionary monetary policy that followed in the 1930s. There were few financial ramifications. The payment system was essentially undisturbed. So there was no money stock collapse, and no financial crisis, and no Great Depression. Now, could I turn to the next slide, possibly the one after, in fact. It should be headed up 1974. Thank you. For another reason, I want to say something now about 1973-4 in the UK, the secondary banking crisis. The secondary banking crisis broke at the end of 1973, and it deserves some mention for reasons that will become a bit clearer in my conclusion. There had not been a crisis, a financial crisis, since 1866. It was not really a serious financial crisis, at least not to most outside the Bank of England, but it is illustrative of several of the features of the financial crises already discussed. And it merits some discussion because of its part in the general trend of the 20th century of the Bank of England increasingly intervening to play some part in the resolution of the problem. Now, there were many diverse elements in the story of the 73-4 crisis. One was the misbehavior of the Crown agents, a body that had to do with the development of the management of colonial assets in London. They deviated from that specific role and went into the banking business for which they were untrained. And they failed. And there was confusion also over where responsibilities lay for different kinds of institutions, such as the Crown agents. But most of the problem derived from the increasingly reckless fringe banks and their behaviour, and from the monetary expansion that encouraged that behaviour. The British banking system had become more regulated in the war and the post-war years. As a result of that, a number of fringe institutions emerged and grew quite rapidly from the end of the 1960s to take advantage of opportunities that were denied to the main clearing banks. The fringe, as the name suggests, remained outside the regulated sector. They lent on property. They were then able to expand greatly with the expansionary fiscal and monetary policies of the Heath government of the early 1970s. And that was given an extra fillip with the relaxation of some construction restraints, and a property boom got underway. And so we're back then to all these elements already encountered: more investment, bank borrowing, a property boom, euphoria, followed by doubts, then fears and panic, as some of the fringe banks found themselves in difficulty and indeed insolvent. Now, some of the clearing banks had close relationships with the fringe banks and found themselves drawn into the crisis more than they would have wished. But the long and the short of the story is that the Bank of England launched a rescue operation called the Lifeboat, and it successfully contained the danger. The bank tried to do all that without itself lending anything, but it was in the end obliged to lend, and indeed it lost some of its loans. The compliance of the press at the time was useful in preventing wild stories circulating about some of the dangers, and that could easily have spread more widely. Now, the bank should get some credit for organising the resolution of the crisis in what might be called crisis management. But I draw attention to this crisis because, on the other hand, it could be said that the lessons from the 19th century seem to have been forgotten. Regulation had returned and intruded and lay behind the crisis developing. Furthermore, the bank's great fear for the reputation of the city and its responsibility for that played their part in it deserting its old role of lender of last resort, providing liquidity to the market, to all those who had good assets, and letting others fail. And this undoubtedly contributed to the notion, already taking hold, that banks would not be allowed to fail. There followed problems with some of the clearers at the beginning of the 1980s that were smoothed over. There was then a small banks crisis at the beginning of the 1990s that once again the Bank of England covered over and sorted out behind the scenes. All of this contributed to the atmosphere of later decades that encouraged banks to take ever greater risks. Now I want to turn next to the global financial crisis. If we could have the next slide, please. These years of 2007 to 9 saw what was undoubtedly the greatest financial crisis of all time. We're really still too close to the events for a proper historical assessment to be made. And that's in spite of the vast literature on all aspects of the crisis, written by journalists, participants in the central banks, other institutions, academics, PhD students, government officials, and no doubt others. But it doesn't really matter how many accounts we have from however many sources. The writing of history requires both primary sources and perspective. Now, some primary sources have been made available, but not enough to make comparisons with others and to cross-check material. Perspective generally means distance in time from the event. That's not a set period, and it'll differ according to the nature of the events being studied, but more time will undoubtedly be required before we can improve our understanding of the crisis and the events that are, in the historians' views, still comparatively recent. That does not mean, of course, that we cannot say anything. There will be little disputing the basic facts, the timeline of important events that led to the crisis, and those that shaped the crisis thereafter. But there will be disagreement over relative importance and even on some of the timing. Detailed analysis can wait. What we need to focus on are the broad problems and how the response was shaped. There were clearly emerging problems in the mid-1920s and, the mid-2000s, and central banks were on some kind of alert. There seemed to be boundless limits on the liquidity in the markets in 2006 and 7. And there was, of course, the accompanying property boom. How could the liquidity disappear? By 2007, there were those who were expressing fears. So I'll set out the main features of the crisis that are quite well known in order to point to the kinds of similarities with the other crises I've been describing. I'll begin with the US before saying something about the UK. The broadly agreed events in the US were as follows. What happened in 2007 was, according to in Bernanke and his co-authors' words, it was a classic financial panic. They repeat that several times. It was a classic financial panic. The crisis began with problems in the subprime mortgage market as a major housing boom came to an end. Property is frequently at the center of crises, and in this case, the boom was linked to government encouragement to everyone to buy residential property. The particular institutional arrangements in the US helped us along. A belief seemed to have taken hold that house prices never fell. If anyone contradicted this, they were looked at in a way that suggested they had not been able to keep up with new developments. Interest rates were low, and the banks were goaded into providing ever more credit. Much of this was going, without due care and attention, to people unlikely to be able to repay by any reasonable assessment. Although subprime was a relatively small part of the credit markets, it did provide the trigger for the crisis. And yet, much as in 1929, economists and others felt that the financial system was robust, the economy was strong. Indeed, some at the time went so far as to say that financial crises were a thing of the past. But as has also been noted, such complacency can blind to problems. What was clear was that when house prices fell, many mortgages were unsustainable. Attention turned to the dependability of other financial assets, and as uncertainty over the value of these spread, the interbank lending market froze. Again, in the words of Bernanke, it was a classic financial panic, a run on the financial system triggered by a crisis of confidence in mortgages. It was fueled, to continue Bernanke's words, it was fueled, as crises usually are, by a credit boom in which many families as well as financial institutions became dangerously over-leveraged, financing themselves almost entirely with debt. So it was a financial crisis in the classic sense, and it followed a pattern of all the great crises of the past. A particular asset sees a persistent rise in price. Government encouragement in this case provided confidence. Borrowing takes place, followed by more investment and further borrowing. Euphoria takes hold, underpinned by the belief that somehow the problem of risk has been solved. But mortgage-related securities that were seen as sound in the boom of course, became close to worthless when the bubble burst. Now, Bernanke had learned the lessons of the Great Depression and had the Bagehot Handbook by him. So when the first liquidity crunch appeared at the beginning of the BNP Paribas news of August 2007, and the ECB injected $130 billion into the frozen credit markets, the Fed followed suit with $62 billion in the well-rehearsed fashion of open market operations, and some calm followed. But at this point, the operation of the lender of last resort comes into play. Bagehot's idea, as I have been discussing, was that the central bank should supply enough liquidity to satisfy those who had a liquidity need. Banks with good quality assets could then get all the cash they needed. But a different reading of Bagehot suggested that the central bank should lend to solvent but illiquid banks on a bank-by-bank basis. If this means that banks have to trot along to the central bank, the danger is that it reveals their fragility to the market. The stigma of being seen going for help could trigger the very pressure from which they've been trying to escape. A liquidity problem can, of course, become a solvency problem if it is not addressed in time. Central banks, however, cannot deal with solvency problems. They are not in a position to supply capital to any institution of even modest size. They don't have the resources. And in any case, it would be crossing the line into fiscal policy if it could bail out failed institutions. Therefore, governments have to become involved. Now, I should remind you here that in no financial crisis of the 19th century in Britain was there any government support provided. But in the back to the global financial crisis, again, like 1929 to 32, it took further turns. No longer had one problem been addressed and some calm restored, and another problem emerged. And so it was with the rescue of the firm Bear Stearns in March 2008, on the grounds that it was too interconnected to allow it to fail. As Bernanke and co-authors wrote of Bear Stearns, the Fed crossed the Rubicon by intervening to prevent the implosion of a non-bank. But no way was then found to save Lehman Brothers in September of that year. New and slightly different problems appeared. And the changing complexity of the sector meant not only that the Fed was drawn into territory it had not been in before, but of necessity, government had to become involved as the scale of the problem in related financial institutions, not normally within the Fed's jurisdiction, unfolded. As hinted before, the Federal Reserve Board, along with the New York Fed and the US Treasury, cooperated closely as they struggled to keep pace with developments, trying to avert the problems where they could be identified, and contain them where they broke out. They speak of the challenges of decision-making in the fog of a financial war. And they further point to legal barriers that prevented them from taking certain actions. Now, the crisis was, of course, global, and many other countries experienced the same or very similar problems in parallel with what was happening in the US. Many institutions around the world were holding the same or equivalent assets. In Britain, the trigger for the crisis came in late 2007, when Northern Rock, whose unusual business model of financing mortgages with wholesale deposits left it hopelessly exposed when the interbank market froze. The background, again, to this was of a long, steady boom in house prices accompanied by credit expansion and similar kinds of beliefs that were held elsewhere on the soundness of property and ever-rising prices. But when that institution failed, fear spread rapidly to others, and after the provision of liquidity on a grand scale was followed by the rescue of major banks that had tipped over into insolvency. This then became the first occasion in which British taxpayers' money had been used to bail out financial institutions. Interestingly, a PhD thesis has already been written on the crisis from the point of view of Her Majesty's Treasury. The Treasury had never in the past played any part in the resolution of financial crises. Crises of this kind were left to the Bank of England to resolve. That was true throughout the 19th century and the various smaller crises that reappeared in the later 20th century. These crises were, of course, in the main liquidity crises. When crises become in the main capital or solvency, government, for both practical and political reasons, has then become involved. And the most recent crisis was the biggest of all, and several institutions certainly required capital injections. Interestingly, in the handling of the crisis in Britain, there arise the same kinds of questions, doubts, and reactions as in the story told by Bernanke et al. For the United States. The Treasury in Britain, and we assume the bank, were at various points unsure of what was happening or how to act, or whether actions would have the desired effect, and so on. And a similar story could no doubt be told for several other countries at the same time. The major central banks have generally congratulated themselves with some justification for taking the appropriate actions. In spite of the severe financial crisis, there was no Great Depression. There was a partly unavoidable recession, though strong reservations have been expressed by some over the fact that no sooner had the necessary liquidity or capital injections been provided than tougher capital requirements were imposed on the banks, thus curtailing the ability of the banks to lend and so dampening the recovery that might have been. So could we move now to the next slide, please? So in conclusion, where are we now? It's easy to look back at a crisis and say, this is what happened, and this is what the central bank did, and the outcome was the following. And the lessons we learned were these. But it's never quite like that at the time. More commonly, the question at the beginning of the crisis, and sometimes as it develops, is what is happening? Following the BNP Paribas credit crunch in 2007, the ECB injected, as I said, $150 billion into the credit markets through open market operations. The Bank of England governor was critical of the actions because it was at that point far from clear what exactly was going on. Shortly afterwards, he changed tack and did something similar when there was a clearer threat of a bank run. But in the relatively recent past, that is the relatively recent past before the crisis, that is in the early 2000s, there had been too many hasty reactions to events in the economy and injections of liquidity, in the US in particular, in order to stave off possible falterings in the economy. And while it may be easy to say a shortage of liquidity is solved by the central bank injecting the necessary amount, if circumstances have changed, as is likely, or if mechanisms have changed, it may be that the institutions that need liquidity and seek it are nevertheless reluctant for fear of a stigma attaching to it, to be seen in need of assistance. So whereas in the 19th century, it was perfectly possible to do that without being identified, in the later 20th century, early 21st century, it seems to have become more difficult. In the global financial crisis, there were many things wrong with the models that economists were using. But to the historian, one of the things that seemed to jump out from 19th century experience was that monetary stability could be threatened by and even punctured by financial instability. Avoiding the latter helped to preserve the former. And yet the view that monetary stability delivered all that was required became prevalent in the late 20th and early 21st century. Frederick Mishkin wrote recently, "Another lesson learned from the financial crisis is that monetary policy and financial stability are intrinsically linked to each other." He later wrote, "Historians always saw financial stability as intimately bound up with monetary stability." So the question is, how did monetary economists and central banks lose sight of that, or perhaps reject the relationship? The global financial crisis exposed a financial system that had many flaws. One was that the socialization of risk had gradually crept in. This was a long process. In both the US and the UK, it had been underway from the 1920s. Together with the too big to fail doctrine, it was responsible for reaching the point where banks believed they would not be allowed to fail. If the price of risk falls, more will be taken. But the capitalist system demands failure. Failure must be a clear possibility, and the possibility acts as a curb on behavior. A bank failing can, of course, be tricky, so resolution regimes need to be designed to cope with the outcome. And some steps have now been taken in that direction. But the regulatory regime was surely also flawed, possibly particularly so in Britain. An aspect of this was that the role of the central bank in the banking system. The Bank of England had been a commercial bank, and it continued to pursue commercial bank business into the 20th century. And then through the interbank market, it continued to be close to the banking system until late in the century. It had an intimate knowledge of the business of banking, a very good feel for the assets they held and for the dangers that might be appearing, and of institutions that might be treading a risky path. But that closeness was fading in the late century and clearly brought to an end in 1997. In that year, the bank had its supervisory and regulatory roles removed. Yet the bank had been given a mandate for financial stability without being able to be sure about the state of the banks and no authority to look closely at them. To some extent, that has now been addressed, but it might still be better if there was a closer relationship with the banking system. Other flaws in the regulatory system were of the kind that often afflict large bureaucracies. And yet the answer to the crisis was to have more regulation. What was needed was better regulation. And it could be said that fundamentally the basis of the regulatory system was at fault. Learning from history, it could have been refocused on providing incentives rather than choices, as some of the literature has described it. For example, it's been argued that regulatory reform should aim to replicate that of late 19th century US experience, and it applies also to British experience. That would introduce a system where regulation could be focused on incentives, one example of which was double liability. That generally resulted in far superior monitoring by shareholders. And studies of double liability regimes have been shown to be much less risk-taking than single liability regimes. The approach is seen as being superior to that of regulation based on choice, something like a simple capital asset ratio, which has led to increased leverage and risk-taking and so on. So, to conclude, central banks can behave in the way desired so long as the banks behave responsibly and where failure is possible and can be readily resolved. The focus should be on the payment system, and the regulatory environment should be suitably accommodating. Thank you. Yes, I'm not sure about that, or indeed any ratio that the rule makers are inclined to produce, on the grounds that I expressed last week, that only the banks themselves know the value of their respective liabilities and assets, and prescribing specific ratios or seeing one as superior to another is a very tricky business, and I'd rather not have to be involved in it. But I think that's absolutely right, and I'm sure I said, and if I didn't, I should have said, in the 19th century, that the Bank of England was frequently responsible for the credit boom that took place in several of these early crises. So they learned about that, and what I hoped I had achieved at the end of the first lecture was to say that they had been through many crises, they had worked out or accepted what their role in these should be, and how generally they should behave as a lender of last resort. One of these was that there shouldn't be any commercial rivalry involved. That meant that they could take the appropriate action without being affected, of course, by any kind of commercial business considerations. So yes, the answer was to these early ones. Then, sadly, they forgot these lessons and have been undoubtedly responsible on occasions for actions that were not appropriate for financial stability. It was in the 2 or 3 years leading up to the crisis that the bank was providing unnecessarily expansionist credit. Yes, that's why I said at the end, towards the end, I think, that the focus has to be on the payments system. And so that is partly why, going back to 1890, when Barings, a very, very prestigious institution, but a merchant bank or an investment bank, when that was in danger, and indeed it did fail, it did not impinge on the payment system. And while it may not have been expressed in these terms at the time, the bank, the Chancellor of the Exchequer at the time, asked the Governor of the Bank of England if he needed to have the gold standard suspended as in previous crises. The Governor said no. The Governor, nevertheless, organised the rescue of Barings, but he didn't consider it to be a financial crisis. If the failure of such a big institution, however, had damaged the reputation of the City of London and had affected other banks, commercial banks, clearing banks, then it would be time to step in and take action to preserve the payment system. And that is what I feel should have been happening in more recent times. Look after the payment system. That's where the central bank has a responsibility. That's where the lender of last resort has its function. And anybody else can do more or less what they like, with the bank watching out to see if what they do impinges or is likely to impinge on the payment system. If it is, it'll begin to take the appropriate action. Well, yes, I mean, I think it began in Britain in the 1920s, when partly perhaps for political pressure, and it's very difficult to escape from that political pressure, but the Bank of England would keep a sharp eye out for any institution that looked as though it was in some sort of difficulty or could get into difficulty. And behind the scenes, it went about finding a bank that would take a bank in difficulty over, or somehow provide a way out of some sort of merger or a way out of the difficulty. It became obvious that the Bank of England was doing that. And that happened frequently from that time on. We can remember the Barings debacle, there was an instance in the 1960s. The bank considered coming to the rescue of quite a small bank, simply because it would look bad for the city, and that happened in the early 1990s. It really is a steady progression, and it was happening in the United States too, so that the perception clearly develops that a bank is not going to be allowed to go under. The circumstances of its resolution, of course, are more tricky, but so long as that perception prevails, then the banks are surely going to take more risky assets. I don't imagine that there's a board meeting of the bank where they sit down and say, look, they're not going to let us go, so let's go mad and make some profits. But the perception seems to prevail, and banks, and then they imitate one another, take more and more risk on board. I suppose the answer to your question is stop doing that and make it absolutely clear that the bank never comes to the assistance of any one institution. Well, I haven't sat down to devise a design. The mechanisms might be provided, although open market operations generally do much of that, but the discount window was certainly a very, very effective means of providing liquidity to the market without individual banks appearing at the bank. If I can just remind you briefly, the commercial banks placed loans with the discount houses, and the discount houses held short bills, commercial bills primarily. And if the central bank was in need of liquidity, they ran down these deposits at the discount house, and the discount house then went to the Bank of England with some of its bills to cash them in, to provide the cash that the banks needed. There's a beautiful system that obviated the need for a bank to appear at the Bank of England requesting extra liquidity. Now, that's the kind of arrangement that it would be nice to replicate. How it would be done nowadays, at present time, I leave to others.
Okay, thank you. Thank you very much, Forrest. It's a fascinating topic. And I very much thank you for your 2 lectures. You've been really generous with your time, very kind. and also attending our questions as well. So again, thank you very much, Forrest, for your contribution to the series.
Thank you.
And to everyone following us from home, thank you for attending these sessions, if only online. We'll have more in the next couple of weeks, starting with the autumn webinar series, and we will put the program with the speakers on our website. Thank you all very much.